All right, friends, so welcome back. So we're going to continue with the audit planning and audit risk and materiality. So we'll continue from where we left off. This is part 2 of the video. All right. So if you have skipped to part 2 of the video, please go and look at the part 1 before you continue from the part 2. Okay. So once again, now I'll make this short. Okay, and then we'll take part 3 of the video. The first one lasted almost 30 minutes. This one, I want to keep it 15, then I'll do the next one 15. All right. Okay, I share the slide, and then we move on. Okay, so at this point, we go to the timing of the critical phases of an audit. Ordinarily, you'll find these key critical phases. So there is the need for always, for pre-planning the audit, okay, ahead of time, okay. And once we plan, it gives us a clear-cut timing timelines for which the audit should be conducted. All right. You'll find the start of the financial year. Okay, so something we need to keep on file and we need to know ahead of time. Then we have an interim audit. Let me use an example like when we're auditing stand chart after 6 months, we go in usually 3 months after the 6 months. So we're going around the same time, around September, to audit their first 6 months work. But of course, during the course of the audit, we sometimes get information up to the ninth month. So we can audit transactions up to the 9 months. It helps us to simply perform some analytical reviews when we come for the final audit. So it makes work very easy once the final year has ended, which is the green arrow you see there. So end of the financial year, in between the end of the financial year and then the directors signing the accounts, we come in as auditors to come and audit the end of the financial year. All right. So then the directors, once we are finished, of course, the directors will then sign the accounts. At this point, you'll find out before the directors sign the accounts, the supporting schedules are available. Auditors have done their work. They have passed the adjustments they have passed on the adjustment, the necessary adjustment for the client to adjust the accounts. Once that is done, final account is available, directors will sign off. There is a particular timeline over there. Okay. And then the auditors will then sign off. Usually you find that the signing off of the accounts by the directors and the auditors will normally take place 3 months after the year end. We try to 3 to 6 months, okay? So if the year ended in December, you normally find auditors very, very busy, sometime between March to June, because they have to sign the accounts and make sure everything is okay for publication. That's why the regulators will give the companies a little over 3 months for them to publish the accounts. So there is then the timeline when the accounts will then be published, and then they go to annual general meeting for discussions on these financial statements. Okay. There are some practical problems which necessitate audit planning. So we need to plan ahead of time. We know the reasons why we have to plan. But again, there are some problems which normally helps us, which guides us, which triggers audit planning in depth. Okay. So clients with similar year ends will cause us to plan ahead. For example, if an audit firm is auditing HSBC and also auditing Barclays Bank, these are two big banks, and let's say they all have the same year ends, and it is the same audit team that will be auditing these two, it's quite tough. Okay, it's quite tough. Sometimes you see, I remember in KPMG, my manager will be on the same job at the same time. One team is here, one team is there. Today he's here, tomorrow he's there. So he's always moving in between two clients. It can be tough, okay? So that's why you have to plan ahead of time and know who can sit on this job and who can sit on the other job, to ensure there's some balance in terms of expertise on the job. There can also be unforeseen problems, okay? Poor internal control environment, fraud, COVID. Nobody anticipated COVID, okay? The energy crisis, well, maybe we saw it coming, but we didn't know it would get to this level. So some of these things could help, will require that we need to plan ahead of time. Sometimes clients will also fail to produce information when we need them. Sometimes they delay in producing it. For example, and I understand them. Listen, I understand them. If you want them to provide you with a pension schedule for the staff, it is the HR person who will prepare it. But when he prepares it, he cannot just send it to you by email. He needs to send it to the HR director to validate and check, maybe send it to the CFO, the senior management, to ensure things jive before they send it to you. So there could be delays. That's why we need to plan ahead of time. Staff we may need on the audit, the audit staff could be sick. So you are relying on Richard to go and do work on critical areas of the audit, and he is off sick or on holidays, on study leave. What would you do? There's nothing you can do. Okay, so we have to plan ahead of time to get people who succeed, a sort of succession planning, so that if somebody is not there, the other person can take over. Of course, we also require different grades of staff and adequate supervision on audits, each audit, so we need to plan ahead of time to get a good blend and mix of expertise. We may also need specialists. Auditors will always need the IT guys to come and do IT assurance of the system. Okay, we need some valuers, we need some cross-disciplinary folks who will come on board to do some job for us. We need to plan ahead of time. There could also be tight reporting deadlines. I remember working on stand charts. Sometimes we sleep at the client's office overnight. You go to work from 9 in the morning and you have to be there throughout the night. The whole day you are there, the whole night you are there. They will ask you, we only close around in the morning, around 8. They ask you, go home, go take a shower and come back. By 11, you should be back and continue the work. So tight reporting deadlines will require that we plan. What are solutions to some of these problems? Some solutions, not all solutions, okay? So we always want to organize interim audits so that the workload will not be too much when we go for the final audit, okay? Pre-plan important dates, okay, like stock taking, cut-off procedures. Sometimes data secularization, we do it from the office. So once the client gives us the go-ahead, you get the client's letterhead, you put the documents on it, you put the standard statement on it and circulate it to the clients, to the debtor. So sometimes even bank confirmation letters could be sent directly from the comfort of your desk. So you send it ahead of time. Pre-booking of holidays and study leave. Listen, you know that you will be on audit A. So can you plan so that your holidays and study leave does not clash with the audit, this particular audit? So we plan ahead with the audit staff, okay? Of course, even the client staff sometimes will also go on holiday. So we need to make sure that when we are on the field auditing, there's a key staff who is not absent on the job on leave, okay? Unless the person cannot do anything about it, okay? I know friends who were auditing. Do you know what happened? One guy I know, and this guy, he was going to have his wedding on a Friday. Yeah, Friday. Saturday. And yet on Friday he was doing stock counting. Okay. Sunday he finished his wedding, and Monday he's back in the office. There was a tight deadline. Okay, so plan this one ahead of time. Cooperate with the internal audit staff so that when you are undertaking activities like visiting branches, attending stock taking, everything will move on smoothly ahead of time. Liaise with them. Again, liaise with the client on progress of supporting schedules. You need a particular schedule, is delaying, get in touch with them, okay? Plan extra time because there could be unforeseen circumstances. Plan ahead of time. It is always important that we organize our planning efficiently. When we talk of organization, you may remember your knowledge from Henry Fayol and those management experts and how they define organization, that we get the logistics, the resources in place at the right time so that our work can move on smoothly, okay? So in planning, to ensure efficient, cost-efficient, cost-effective procedures in the organization, what we have to do is that we must establish efficient time recording and costing methods within the audit firm. It helps in billing the clients, okay? Prepare detailed time and cost budgets. It helps in billing the clients or determining our audit fees. make sure we have the available resources, the right blend of expertise and knowledge, the guys who can help us when it comes to verifying the tax schedules, okay, the IT systems, a good blend, okay, of technical know-how, of manpower. Again, we also want to ensure that we have good and consistent working practices. The audit procedures and manuals are in place. Standard working papers are in place, checklists, okay. Everything we need in terms of the manuals, the procedures, standard operating procedures to help us work efficiently. We need to get all of these in place. Poor auditing. Most of the scandals we find on board are because of poor auditing. Okay, sometimes planning is good. They've done the good plans, everything, but people don't work according to plans. Sometimes there are no plans at all. Sometimes people go and think last year is the same as this year. So you hear them saying Sally, same as last year. They just do the same thing over and over. So you can see the audit outcome becoming very poor. Okay. We plan sometimes, but we don't use the right guys on the job. It leads to poor planning, poor auditing. Okay. So there was no planning, like I said. There was planning, but it was not executed. They planned, but sometimes they made it so strict jacket, they don't want to amend or modify it. Okay. The audit was begun even before they completed the planning. Like I said, finish the plan before you start. But of course, along the line, you can adjust and amend the plan to conform with the changing trends, the dynamics of the work. Okay. And the audit was based on plans which hasn't changed in years. So they keep rolling it over, same as last year. And nothing is done. They just change the date of the audit plan, the APM, and they continue and use it for this year. No, don't do that. Okay. Again, auditors did not get a full understanding of the business they are going to audit. You bring new guys on the job who know nothing about the client and they are not prepared to read and learn about the client. You are just doomed. You are just doomed, and you should prepare some millions of pounds to pay as liability. Okay. We must also understand the controls, like I said, okay. And our days will only focus on only the controls that address significant risk. We only focus on that. But quickly, let's look at this. So you must understand the internal control systems. But key to this is that which controls will impact a significant risk or could trigger a significant risk. Okay. Those ones, we need to look at them. We'll look at that again in the next slide. But again, consider controls over journals, not only journals which are used to record the normal stuff, but consider journals which are also used to record the unusual stuff, non-recurring transactions or adjustments. Suspicion, okay, professional skepticism, keep it in mind, okay? So the idea is that we want to be sure that the staff, the client, is not using these journals to hide or conceal some fraud or misrepresentations. Okay, so the journal entries, and normally those ones which occur at the year end, very important to review. If you can review everything, review all. And then go back immediately after the year end, the cutoff, and check what has been reversed. Okay, they normally do that. They normally do that. Of course, at the workplace, sometimes we leave things to the last minute and we start to adjust. No. Also, controls for which the auditor plans to test operating effectiveness. Sometimes we will not conduct substantive testing, the calculations, the analysis, the numbers. Okay, we don't want to do those ones, but we want to see the controls over this particular area. Is it effective? Okay, is it effective? Okay, so consider these controls, okay, as part of your planning, though we will not conduct any substantive testing. Now, those controls which address significant risk, like I said, I've gone to come back one step. So those controls, like I said, we must understand whether the entity has actually designed and implemented controls for significant risks, okay, arising from non-routine or judgmental matters, which may include whether or not management responds to these risks. So areas where we know they are prone to high risk, has the company put in controls? Do they monitor it? Do they run it to the letter? Okay. For example, these types of control will be reviewing the assumptions used by senior management in preparing the financial statements. Okay, what assumptions do they have? Review those. Okay. And then any documentary evidence or processes which management use in passing some estimates, okay? Be careful. Estimates, because it's based on axioms and postulates. They may always have the propensity to be rigged. Okay, I don't want to say to be fraudulent. They can rig it. Okay, so be careful on those areas. Any approvals by those charged with governance, the management, the directors, what approvals have they passed? Okay, and also look at other controls that the auditor feels are appropriate to deal with risk at the assertion level. So all the assertion levels of that management may have passed at the income statement level, at the disclosure level, at the statement of financial position level. Okay, you need to look at all of these. Audit planning and risk, you plan better, you reduce the risks. Okay, you plan better, you reduce the risk. So planning is very important to ensure that our auditing is successful to a greater extent. Now, planning as well should include logistical factors, like I said, the staffing level, the timing of the work, the cost involved, the budgetary implications. Okay, the understanding here is that it will help us to estimate what we call the audit risk. What is the audit risk? So audit risk is we're simply looking at the risk that the audit may not give the correct report or opinion. Why? Because the financial statement may contain errors, okay, or misstatements, but the audit's work undertaking will not be able to detect these errors or misstatements. So we end up issuing a wrong opinion. Okay. Normally we give them clean report when it is actually not clean report, because there are some errors, there are fraudulent stuff, but we couldn't detect it. Okay. Now that is because we end up not doing a good job. Our planning may be poor or may not be robust enough. Okay. Now, audit risk is a function of three things. Okay. It's a function of what we term the detection risk. Detection risk is the risk that the auditor's own procedures fail to detect a material error or misstatement. And then the risk of material misstatement. Now, the risk of material misstatements are two items. One, control risk. Two, inherent risk. Okay, that's what we are looking at for now. So audit risk is a function of inherent risk and control risk and detection risk. Okay, so risk assessment in these scenarios is actually a matter of professional judgment by the auditor. I'll wrap up soon, then we'll take the next step. Okay, so risk of a material misstatement, we want to assess it at the overall financial statement level. Okay, so any pervasive risk which may affect many of the underlying assumptions, which we term as assertions, must be reviewed. Okay, then you look at the transaction level. Okay, so assertion level for classes of transaction, account balances, and disclosures. You remember them, the completeness, the rights and obligations, okay, the existence, the accuracy, those ones we're talking about. Okay, so the auditor will then have to make an assessment of the inherent risk. What is the inherent risk? So those risks which pertain to the company due to the nature of their business, even if controls are there, the nature of the business will expose the company, will cause them to incur some risk. Okay, and then control risk combined will give us the risk of a material misstatement. That's why I said here that audit risk is a function of what? Two things are inherent within, two things, I don't want to use the inherent, two things are embedded in the risk of a material misstatement: control risk and inherent risk. And then we have detection risk. So three risks. Some are combined, okay, will give us the audit risk. All right, let's move on. So inherent risk, like I said, the risk of a significant or material misstatement to either what to either a particular class, a particular transaction or class of transactions, or to the financial statement as a whole, without consideration to any internal or other controls. So controls are there. Let's leave them. Let's hang them. Let's keep it as a constant. Like a regression equation, we keep it as a what? As the alpha, constant. Leave the controls out. Okay, but from the nature of the business, there are risks inherent. company. Okay, so how do we determine this inherent risk? It is derived from the nature of the business and the business environment in which the company operates. The industry itself also plays a key role. So look at the nature of the entity's business. Are they into construction? Okay, construction company, we are saying it could be more volatile than a fruit importing business. Okay, what is the quality and expertise of the management in that company? What is the level of competition in the business market in which the company operates? The complexity of the operations, is it simple or quite complex? The cash situation, the liquidity prospect or situation of the business, their trading history, okay? The changing trends of the business transactions, okay? Even the industry in which they operate, the environment in which they operate, okay? So ISA 315, which tells us to understand the entity and the environment in which it operates to help us assess and identify risk of material misstatements, gives us a number of factors, okay, which could impact inherent risk, okay. Complexity, we mentioned it, okay, arising from the information itself or the way the information is prepared. Subjectivity, who is preparing it, okay. Does he use a standardized metric or his own mindset? Okay. Changes. Are there some regulatory changes which could impact the way management prepare their accounts or which impact the basis upon which management prepare their estimates? Uncertainty is also one, which is where we're talking of it is not possible to provide a precise and comprehensive information through observation, okay? Or there is lack of information available. So, of course, we would doubt the reliability of the information given to us, okay? Susceptibility to misstatement due to management bias or other fraud risk. And normally this could be intentional, fraudulent, or unintentional errors, okay? All right, so these factors normally affect the inherent risk. There is what we term the spectrum of risk, and from here I'll just end it. So inherent risk is higher for some assertions and lower for some assertions, okay, it depends. So it depends on the likelihood of it occurring and the magnitude of impact it will have on you. If the likelihood is high and the magnitude of impact is high, then you know the risk will be very significant, okay? There's to be very significant. So the spectrum ranges from significant risk and minimal risk, okay? So when the likelihood probability of it occurring is low and the impact is low, minimal risk, would we devote so much time on this? No. Okay, so it is all driven by the auditor's understanding of the risks of a material misstatement. Based on their understanding of the controls, the auditor's understanding of the controls, how they have considered or assessed these risks and the extent of work they have conducted. Okay, this will tell them, okay, so you find this spectrum of risk, okay. The shaded area, the gray area are low risk, because the likelihood of it occurring are normally low. The magnitude of it occurring is also low, minimal to moderate. But those areas above the shaded area, you see that the magnitude or the impact it will have is high. Okay. In fact, the item that one, this, I don't know whether you can see this particular item, the X, which is almost closer to the line, to the gradient, looks like even an area of moderate risk. Okay. But anything that has a higher likelihood of occurring and then the higher magnitude impact on the organization in terms of the risk assessment, inherent risk assessment, okay, is area of a significant risk, and we need to engage more on this, okay. So the higher on the spectrum the risk falls, the more persuasive our audit evidence needs to be, okay, Otherwise, we need to flag it out, okay. So inherent risk is considered, again, at the company level, at the transaction level, and as an auditor, you must consider an assessment of the business risk of the company, okay. So once again, ISA 315 comes in handy. Understand the nature of the environment in which the company operates. Understand the business, the type of business they do. Forget about the controls, level of controls which are at hand. Forget it. Irrespective of the level of control, consider the nature of their business and the environment. Okay. So at assertion level or transaction level, we need to look at risks which are caused by complex transactions, accounting estimates. Okay. So once you are assessing this business risks, consider any risk: political risk, legal risk, environmental risk, okay, economic risk, financial risk. Consider all of these risks. All right. So we'll end on the inherent risk. Then we'll continue the next bit from control risk, and then we'll wrap up. Okay. All right. So at the business level, what should I consider? Business level, consider the nature of my business. Okay, the business environment in which I operate, the history of my company. Okay, consider any unusual transactions, the cash situation of my company. Okay, if a company doesn't have cash, the cash situation is poor, it is dead. Remember, cash is the lifeblood of any company. As a human being, if you don't have blood, you are dead. So if the cash situation is questionable, remember, it is an inherent risk. At the transaction level, consider how is it easy to defraud the company? How complex are their transactions? Okay, the level of judgment involved in agreeing values or in putting down values. And then, okay, so for example, inventory is inherently riskier to value than cash. Inherently riskier to value than cash is cash. £10 is £10. But if I tell you this is the inventory, the amounts I use, how would you put value on this? Okay. We'll end here. We'll continue with control risk as the third part, and then we will see what next we have. Okay, friends, good to see you. I'll see you again. Bye for now.